Welcome to our channel, where we break down complex financial topics into simple and clear explanations. Today, we're diving deep into one of the most powerful institutions in the world, the Federal Reserve. You might think the Federal Reserve only matters to bankers and economists, but its decisions quietly shape nearly every aspect of your daily life. From the cost of your groceries to the interest rate on your car loan, the Federal Reserve has a hand in it all. So, let's uncover how this central bank truly impacts your wallet, your job, and your future. Let's start at the beginning. The Federal Reserve, often called the Fed, is the central bank of the United States. It was created in 1913 to stabilize the financial system after a series of banking crises shook public confidence. Its main purpose is to manage the country's money supply, regulate banks, and keep inflation and unemployment in balance. Think of it as the organization that quietly keeps the economic engine running smoothly behind the scenes. Most people rarely think about the Federal Reserve. But every time you borrow money, use your credit card, or even notice prices changing at the store, the Fed's influence is at play. Its policies ripple through the economy, affecting both individuals and businesses. And those ripples can feel like gentle waves or powerful shocks, depending on the situation. One of the Federal Reserve's biggest responsibilities is setting monetary policy. This means controlling how much money is flowing through the economy and how expensive it is to borrow that money. The main tool it uses for this is the federal funds rate, the interest rate banks charge each other for overnight loans. When the Fed raises or lowers this rate, it creates a domino effect that impacts almost every loan and credit product in the country. When the Federal Reserve raises interest rates, borrowing money becomes more expensive. That means higher rates on mortgages, car loans, and credit cards. For example, if you're thinking of buying a home, a rate hike could increase your monthly payments by hundreds of dollars. This often slows down consumer spending and cools off the economy. On the other hand, when the Fed lowers interest rates, borrowing becomes cheaper. This encourages people and businesses to spend more, invest more, and take more financial risks, boosting economic growth. But the Fed doesn't just adjust interest rates randomly. Its decisions are guided by a dual mandate: maximum employment and stable prices. In simpler terms, it wants as many people working as possible while keeping inflation under control. When unemployment is high, the Fed usually lowers interest rates to encourage job growth. When inflation gets too high, it raises rates to cool things down. It's a delicate balancing act that affects everyone, from workers to retirees. Let's talk about inflation, one of the most noticeable ways the Fed touches your life. When inflation rises, your money buys less. Groceries, gas, and rent all become more expensive. The Federal Reserve uses interest rate hikes to reduce inflation by making borrowing more costly, which slows down spending. This can help bring prices under control, but it also risks making loans and mortgages less affordable. So, when you hear news about the Fed fighting inflation, it's not just economic jargon. It's about protecting your purchasing power. Now, imagine you have a job or run a small business. The Fed's policies can determine whether your business thrives or struggles. When borrowing is cheap, companies can expand, hire more workers, and invest in new projects. But when interest rates climb, borrowing becomes harder, and many businesses may cut back or even lay off employees. This is why the Fed's decisions are watched so closely by investors, CEOs, and workers alike. Another major influence of the Federal Reserve comes through its role in stabilizing the financial system. During times of crisis, like the 2008 financial crash or the 2020 pandemic, the Fed acts as a lender of last resort. It provides emergency loans to banks and financial institutions to prevent a total collapse. By doing this, the Fed helps keep money flowing through the economy even in dark times. Without its interventions, millions of people could lose access to credit, savings, and even their jobs. The Federal Reserve also controls something called quantitative easing, This is when it buys large amounts of government bonds and other securities to inject money into the economy. It's like opening a faucet to increase the flow of money, encouraging spending and investment. This strategy is often used when interest rates are already low, but the economy still needs a boost. However, too much money flooding the system can lead to inflation, so the Fed must be careful. Your savings account is also tied to the Federal Reserve's actions. When the Fed raises rates, banks usually increase the interest they pay on savings. That means your savings might grow a little faster. But when rates are low, your money earns less interest, even though loans are cheaper. This creates a trade-off between saving and spending that directly affects your financial decisions. Let's not forget the stock market. Investors hang on every word the Federal Reserve says. When the Fed signals rate hikes, stocks often fall because higher borrowing costs can hurt corporate profits. When the Fed cuts rates, the stock market usually rises because cheap money fuels business expansion and investor optimism. Even if you don't invest directly, these market moves can influence your retirement fund, your job stability, and even consumer confidence. The housing market is another area deeply tied to the Fed's policies. Mortgage rates are influenced by the Fed's interest rate decisions. When rates rise, fewer people can afford homes, which slows down the real estate market. When rates fall, more buyers enter the market, driving up home prices. So, the Fed's decisions can determine whether it's a buyer's or a seller's market. Beyond loans and investments, the Federal Reserve also plays a crucial role in regulating banks. It ensures that financial institutions have enough reserves to handle customer withdrawals and emergencies. It sets standards for risk management and oversees banking practices to protect consumers. When a bank fails, the Fed works behind the scenes to prevent widespread panic and economic damage. You may also feel the Fed's influence through the value of the U.S. dollar. When the Fed raises interest rates, the dollar typically strengthens because investors want higher returns on U.S. assets. A stronger dollar makes imported goods cheaper, but hurts exporters because American products become more expensive overseas. So, if you notice prices of foreign goods changing, part of that story leads back to the Federal Reserve. The Fed's communication strategy, its statements, press conferences, and forecasts also shapes expectations. Even before it takes action, just signaling a potential rate change can move markets and alter business plans. This is why you often hear about investors pricing in future Fed moves before they even happen. Its power is not just in what it does, but in what people believe it will do. While the Federal Reserve's main goal is economic stability, its actions can sometimes have controversial outcomes. Some argue that keeping interest rates too low for too long can create bubbles in housing or stocks. Others believe raising rates too quickly can trigger recessions and job losses. It's also important to remember that the Fed's decisions don't operate in isolation. They interact with government policies, global markets, and consumer behavior. For example, a global oil shortage or a war abroad can complicate the Fed's job by driving up prices regardless of interest rates. This makes managing the economy more art than science. So, the next time you hear about the Federal Reserve in the news, pay attention. Its policies shape your cost of living, your job security, your savings, and your ability to borrow. Every decision it makes filters down into your daily financial life, whether you realize it or not. The Fed might seem distant, but its reach extends right into your pocket. In the end, understanding how the Federal Reserve impacts your daily life empowers you to make smarter financial choices. You'll know why interest rates change, why your credit card payments rise, or why the job market shifts. Knowledge of how the system works helps you navigate it better and plan for the future. If you found this explanation helpful, don't forget to like this video. Share it with others who want to understand how money and policy connect. And make sure to subscribe to our channel for more deep dives into the forces that shape our world. Thanks for watching, and see you in the next video.